Hi, I'm Allie Swafford, President of Prosperity Partners Wealth Management. A recession and a rally like no other. Imagine yourself at the beginning of the year. You have knowledge that within weeks a novel virus will emerge that will shut down much of the global economy, businesses will close, sporting events will be canceled, your daily routine will be altered, travel plans will be derailed, and tens of millions of Americans will be thrown out of work. There is no preventative vaccine, no cure, and the virus can be contracted like the common cold or the flu via airborne contact. This will turn into a health and economic crisis no one alive has ever experienced. It sounds like a Hollywood studio script, yet it's the reality of 2020. With the foreknowledge that a global pandemic and economic collapse is on the horizon, how might you position your investment portfolio? Many would have correctly anticipated a swift sell-off of stocks as the virus swept across the globe and the U.S. economy went into hibernation. The safety of cash or long-term bonds would have been alluring. But consistently picking the peaks and valleys in stocks, or even something close, is a fruitless endeavor. We know that intuitively. When might the investors who had fled to safety decide to repurchase equities, returning to the proper asset allocation designed to achieve their financial goals? Would the unending drumbeat of bearish sentiment have kept them out of the market and in the safety of cash or government bonds? For many, it's difficult to pull the trigger when news is bleak and there's no light at the end of a dark tunnel. The swift sell-off in stocks is in the record books. It was violent but short-lived. As the economy was on the precipice of its worst quarterly decline on record, the major market indices touched bottom in late March and began a remarkable rally that few thought was possible. According to a mid-August article in Barron's, the Dow Jones Industrial Average registered its best 100-day advance since 1933. While the Dow has yet to eclipse its prior high, the S&P index set new records multiple times during the month of August. Strength in a few large technology stocks have helped fuel the rise in the S&P, while strong technology performance has fueled a spectacular advance this year in the NASDAQ. The pandemic has changed the rules. There's no playbook to model outcomes. The Fed, economists, and analysts are all playing by new rules. Aided by fiscal and monetary stimulus, price action in the market since late March accurately called the bounce in economic activity that began in May and has continued throughout August. However, let's acknowledge that the recovery did slow in July, and while the recovery is in recovery mode, it's been very uneven. We're seeing a strong stock market, which has been supported by unprecedented liquidity supplied by the Fed, rock bottom interest rates, and an improvement in the overall economy. Buoyed by low mortgage rates and pent-up demand, housing activity, a traditional leading economic indicator, has surged. Retail sales, as measured by the U.S. Census, have surpassed pre-COVID levels. Pent-up demand, generous jobless benefits, and stimulus checks have all contributed to the economy. The Atlanta Fed's GDP model inputs economic growth into a complex report that tracks annualized growth, and right now is predicting that the third quarter could see as much as 28.5% increase. While moderation could occur prior to this quarter's end, anything north of 16.7 annualized GDP growth would set a new record. But blemishes remain on the economic landscape. It's been a very uneven recovery. While companies have been recalling furloughed workers, total employment remains well below the pre-COVID peak. For example, the U.S. economy has yet to reclaim even half of the 22.1 million jobs lost in just March and April. July's unemployment rate was 10.2%, down from April's peak of 14.7%, but still remains well above the 10% peak that occurred in the Great Recession. First-time claims for unemployment benefits have been hovering near 1 million each week, again well above the 665,000 peak registered in the Great Recession. Meanwhile, the economy may need another shot of fiscal stimulus, but lawmakers are at an impasse. A liquidity crisis was avoided when the Fed flooded the financial system with cash, but economic output remains subpar, and potential solvency issues among homeowners and businesses may create new hurdles down the road. We at Prosperity Partners remain bullish on the long-term prospects for the U.S. economy, but we're monitoring short-term risks. Outsized gains in a few technology shares leave the market vulnerable to a pullback. When we see stocks priced at lofty levels, any unexpected surprises can create volatility. The path of the virus remains top of mind. Fortunately, the midsummer spike in cases has subsided, according to Johns Hopkins. Yet we could see a second wave in fall or winter. We might see a resurgence in the virus with the reopening of schools and colleges. What if the massive effort to develop a vaccine comes up short? The election is barely 2 months away, which definitely will create headline risk. Or might tensions between the U.S. and China generate more waves in the market? While markets don't always get it right, they attempt to price in the future. Markets are made up of millions of investors that have a financial stake in the decision. Current market price actions suggest the economy will continue to improve, though the pace of improvement is uncertain. The economy may not be the same when the pandemic is behind us, but we are a resilient people. We will persevere and we will adapt. If you have any thoughts, questions, or concerns, feel free to reach out. That's what we at Prosperity Partners are here for, to help you, to join with you, to partner with you, to make sure that we all not only go through this pandemic together, but come out the other side stronger and even better. Thank you.